Hello everyone. My apologies for the delay. I had some technical issues. Hopefully there are not a lot of people that have left the session already. So today we're gonna discuss about position trading. Let me double check that everything is okay. I would really appreciate basically a confirmation regarding the audio. Okay. And as usual, feel free to ask anything you want. I will be here to reply to any questions. So until I have some feedback from you, I'm gonna go through admin as well, the disclaimer warning. So this matter is provided as general marketing communication for information purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment leveraged product is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as Forex derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. You can find our risk disclosure in our website along with any legal documentation that you might want to see. So guys, as usual, this webinar is being recorded. So once we finish the session, you're gonna receive the recording in your inbox. Give us some time until the team manage to upload the recording in the YouTube channel. So okay, today we're gonna, as I mentioned, we're gonna go through the position trading in Forex. Let me just, okay, get rid of this one. Up. Perfect. Muhammad, you cannot see my screen, you mean? Let me know. Okay, so we're gonna go through what is position trading. We're gonna also see how you can adopt a basic position trading strategy, some useful indicators as well. Also, I have included around 5 or 6 different position trading strategies, along with some examples for each one of them. And we're gonna go through together some limitations and risk that you need to be aware if you're going to try and apply a strategy on a position trading strategy. Any questions are more than welcome, so feel free to stick it on the question box. Okay, first of all, let's start with the basics. Okay, let's see what let's go through what position trading is basically. Okay, so first of all, as you already understand, it's a type of a trading approach, right? More precisely, is a position trading strategy. Let me just, okay, Okay, position trading strategy is one of the is actually from all the types of trading. Okay, position trading is considered to be one of the longest holding times one. Okay, so it's let's say an upscale version of intraday trading. Uh, Position trading basically represents a trading style at which the trader is holding the position open for a long period. Let's say might be a few days, a week, or even a month. So, so this is the approach. Position trading is when someone, an investor or a trader, buys or sells an instrument. However, it holds the position open for a over the course of a longer period of time. So usually position trading is done by someone who is less, let's say, disturbed by short-term price fluctuation and any news any news that might be just any days news, let's say, that are not changing the fundamental picture of an instrument. Okay, so that's why, because it's something that is a more of a medium term or even a long term approach. Position traders usually ignore any intraday movements, any short-lived price movements, and rely basically on, for their decision, they rely more on precise fundamental analysis, and they are observing mainly the long-term trends of an asset. So this is the type of trading that we're referring to. Okay, so of uh, one of the actually a very famous example, very famous example uh, that represents a position trading um, um, actually it's an example of a position trading, sorry. It was an example that Joe Ross spoken about in his latest newsletter. And it might be one of the longest example of position trading or on record. Actually is a trading that is a position that has been held for nearly 10 years, from 1991 up to 2000. So the particularly it was regarding the S&P 500. So the investor in question opened a long-term position in the S&P 500, which he held for a long period of time, basically up to 2000. And he managed to do that by setting a trailing stop that was triggered only when he felt that it was a good profit. And actually that good profit, it was around $16 million. Okay, so other famous basically position traders that you might know is Philip Fisher, and of course the famous uh, the famous Warren Buffett. Okay, you know, these two people are two of the greatest investors, uh, um, and actually they've been followed by a large crowd of admirers, traders, investors. They made some excellent investments over the years and up to now, basically focusing only on encouraging data and on good, wealthy companies, stocks, assets, etc. So, for example, Fisher in 1955, he made a long-term investment in Motorola shares, and he held that position until his death at the age of 96. Okay, are you with me, guys? And no one confirmed that you can hear me. You can see my screen. Hmm. Thank you very much, Juan. Thank you very much, Muzi. Welcome. I don't think I've seen you before in a session. Welcome. Hopefully you enjoyed. So let's move on. Go a bit more in depth, let's say, of the position trading. So before I move into ways for adapting a basic position trading strategy, I would like to make sure that everyone understands what exactly it is. So guys, it's quite simple. Anything that includes holding a position for a long period of time, not necessarily months and years like these guys, but I mean few days, few weeks, etc., is considered to be a position trading approach. Okay, so the difference between difference, let's say, of a position trading and day trading is the time of the time frame and the holding period. A day trading, as you already know, is within a day. Swing trading, for example, is days to weeks the maximum. Okay, but swing trading is medium term. Day trading is short term, while position trading, it could be up to, it definitely needs to be more than a day, okay, but it could be up to months. Okay, so however is this approach? Okay, you can tell me, but why shall I choose something like that? I prefer to have some small, short, fast trades. I'm a scalper, or I prefer to not to worry about the position. I prefer to close everything within the day, etc., etc. That's fine. That's your character. That's your approach, your psychology. That's totally fine. Okay. This approach, this strategy, this style is for anyone that either that they don't have a lot of time to spend in order to monitor the market constantly, or they prefer to have to capture large moves in the market, um, and they have the patience to wait and wait and wait until they earn a greater profit than a short-term trade, or it's for someone that let's say that they prefer to have low transaction cost, because position traders enter and exit the market less frequently than day traders. So that results in lower transaction costs. But yeah, mainly the key benefit of position trading is when a trader don't have to can't monitor the market constantly, so that reduces the stress and allows traders to focus on other strategies, on other activities that they may have. They might be busy, etc., etc. So yeah, of course, there's some risk with position trading that we're gonna go through later on. But you need to understand that position trading involves only to hold a position open over a long period of time. It's very, very similar to investing, okay? But the difference is that the position traders can speculate on downturns, right? So they can go also short, and they don't own the underlying asset as well. By the way, just to clarify something, position trading is not only about indices, because I gave the example of S&P 500, but it can be applied to a range of markets like stocks, shares, commodities, indices, Forex. Okay, so okay, so so let's move on. Let's move on. I think we covered pretty much what is position trading and how it works. Let's now dig a bit in the features of a position trading strategy of a position trader. So the term position trader, as you understand, refers to anyone that holds a position open, as we said, for a longer period of time, as we already mentioned. So, and as I mentioned earlier, position traders are less concerned with short-term fluctuations unless if it's something that can impact the long-term outlook of their position. Okay, and guys, you need to understand, anyone that is applying position trading strategy is basically applying a trend trading a strategy. A position trader is by definition a trend follower. Okay? Because holding a position open for a long time implies that you have seen the overall trend, you have studied the fundamentals, and you have studied the momentum, and you are aware that everything supports that the overall trend will continue for a while. So by definition, position traders are trend followers. That's why usually most position traders do not trade actively and are surpassed by long-term buy and hold investors in the length of the time. So, okay. Something that I haven't clarified is the fact I did mention that they dig into the fundamental analysis and they really rely on the fundamental analysis. So this is the prime tool of a position trader. Okay, fundamental analysis is one of the most important tools, a tool for position traders. So analyzing the GDP, the interest rates, the inflation, in general, how the economy is gonna how healthy the economy is, or if they trade stocks, whether a company is wealthy or not. So they're gonna go through the earnings reports, the financial statements, etc., etc. That's their prime tool. But they also use technical analysis. I mean, the position traders, position trading is a combination of technical analysis and fundamental analysis. That's why they are trend followers as well. So they taking into consideration the market trend, historical patterns, right? And the fundamentals. And if everything is in line, if everything points to the same direction, this is when the decision will be taken. So also history has proven that good position traders are those who can successfully identify the right entry and exit point and know when to place a stop loss order. Okay. Now, we mentioned that it's a combination of technical fundamental analysis. So here are, we're gonna start presenting basically some examples of popular technical indicators that can be used for position traders on any of the financial markets. Okay, let's start with the 50-day moving average. Okay, let me just, okay, sorry, my bad. Here we are. Okay, with the 50-day moving average. So the 50-day simple moving average is actually an important technical indicator in position trading. And the reason why we use the 50-day simple moving average in the position trading is that the 50 is a factor of both 100 and 200 day moving average. So with the 50-day moving average, the 50 basically day moving average gives a precise, let's say, all of them, the 50, the 100 and 200, all of them give a precise indication of the long-term trend, okay? Which is what we want to observe first. We want to identify the long-term trend, the overall trend of an asset. So this, the 50 more precisely, because it's a factor of 100 and 200, it will give a very precise indication for the long-term trend. If you combine the three of them, even better, because the cross of the 50 moving average with the 100 and 200 day moving average will indicate a potential entry point. Okay, so it's used, the interaction between them, it's usually used for spotting the start of a new long-term trend. So basically could be used as a nice trigger point, entry point. Okay. Okay, and before I go to an example, let me also explain a bit the second example of popular technical indicators that you can use for position trading, which is also obviously support and resistance levels, right? Support and resistance levels show, as you already know, or some of you already know, the direction in which the price of the asset is going, right? So support and resistance level presents to position traders whether it is better to open or close a position for a particular on a particular asset. Now, short-term support levels may occur, okay, but okay, basically we have the short-term support and resistance levels, right? We have also the historical support levels that might persist for years, for months, for weeks. On the other hand, resistance levels, right, refer to the price threshold that an asset seems historically unable to overcome. So what the position traders are doing, basically position traders will use the long-term resistance, I mean a resistance that is holding for weeks, for months, for even years, okay? And they will use this kind of resistance levels, the historical resistance levels, for deciding when to close a position. Why? Because they rely on the expectation that the asset will drop upon reaching this level. So with the same mentality, let's say likewise, position traders could enter a long trade at support levels because they rely on the expectation that a long-term upward trend will begin if the support level is being reached. Okay, so far so good, hopefully. Now let's move on. Let's see some examples of support and resistance levels, support and resistance approach. Okay, the support and resistance, sorry. Okay, support and resistance, the support and resistance, as I mentioned earlier, they are used to identify trading entry levels or close levels in position trading. As you can see over here, we have some examples, and you can see that there are certain prices on the chart, okay, that attract either buyers, and you cannot see my cursor, let me just drop, not the pen, a cursor, okay. You can see that there are some areas that attract buyers and some other areas that attract sellers, okay. So these price points is the well known to everyone support and resistance levels. So a price is considered to be supportive when there are more buyers than sellers, right? The same vein, the resistance price is a price at which there is likely to be a greater number of sellers than buyers. Okay. So so it is quite likely that the price will first increase to the resistance level, then level off, use all of the available supply, and then begin a downtrend. So this is the case when it breached the resistance. When there is, let's say, like in the example that I have in the right hand side, when for instance, if we have an upward trend in the market, okay, one of the most important parts of the technical analysis is to try and find out resistance levels, key resistance levels, historical resistance levels, in order to put a note on it, a line on it, and monitor whether and keep monitoring basically, because the resistance, as we mentioned already, will present basically a potential catalyst of selling. Okay. So one of the most important ideas to remember is that if a level of support or resistance is reached, its function will switch places. Yeah, so let's dig a bit on the example. Let's have a look on in an example, basically. Okay. So let's have a look on this example over here. We have seen some selling occurring at resistance levels and some buying occurring at support levels. So any um, um, if you consider, if for example you are holding an asset, let's say stock, and the price breached support or resistance level, it is a sign that you should either consider selling or buying the asset according to the line. Now, let's focus a bit on this example over here, okay, at which we have seen that the asset, after retesting resistance levels twice, okay, it managed to break it and move above it over here. So there wasn't the breakout over here, okay, indicates that buyers had the control of the asset. And actually, remember what I told you earlier, that any breakout could indicate also that a long-term trend might start. So let me just. So in these cases, be aware that the resistance level has now turned into a support level that you can use in the near future, either as your stop loss level or trailing stop loss, etc., etc., etc. Now, just double check whether I covered. I would like to take a step back again and get back to the 50-day moving average, okay? Just to show you how a moving average indicates the end of the trend or the end of the trend, or indicates that the trend will hold for longer. So you can see that here we have a 15 period moving average, but every time that the asset retested the moving average, that was a rebound away from the support level. So that rebound is what attracts more buyers, as we said. So buying, 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 buying. So adding to the existing long-term position, while a move below it suggests that it's time to, because sorry, while a close of the position, sorry, while a break of the moving average and a move below it suggests that the trend is over. Now that moving average has turned into a resistance area, so you need to consider closing your position and consider taking a new position based on the new trend. Okay. Okay. I would like to focus a bit on the breakouts, okay, because I mentioned the breakout here earlier, actually before the breakout, because I mentioned the breakout here, but let's see here is another example of the 50-day moving average, okay? Retest, okay, above it, held, retested. It's not only that, there is a doji candle and a rebound that looks a bit like an evening star, not precisely, but it's another confirmation that it will extend higher along with the retest of the 50-day moving average. So That could be an entry point, another entry point that you can add on your existing position, another one, and so on and so forth. Now, actually, you should have in mind, before I move on to the breakout, you have guys in mind that in general, the majority of the position traders are using basically, they are searching, they're doing their research regarding growth stocks, assets, and etc. And or they are checking for any breakouts and etc. So regardless, okay, on the side though, after they're doing their fundamental analysis or they have spotted the breakout and etc., they tend to trend to the 50-day moving average as one of the most reliable and well-respected technical indicator available, just to confirm whether their decision to enter a trade is correct or not. Okay, so the big investors and traders can quickly determine if a company is strengthening or weakening, if the price of its shares, let's say. So they are doing that by analyzing the position of its current price in relation to the 50-day moving average, because this line, this 50-day moving average, provides the information that I told you about, provides the information based on the stock's historical performance. With the exponential moving average, you will not have this one. I mean, with the exponential moving average, the line will represent the recent price activity and not the historical performance. Okay. Yeah, just having in mind, just to understand the difference between the simple and the exponential line. Yeah, so for stock traders, position traders, that they open such position in stocks and indices, etc. We have seen over the years that the 50-day moving average, a simple one, is a preferable tool that they choose to use. Okay, now let's dig in more in how you can trade breakouts. So, okay, very useful for a position trader is to spot a breakout of a resistance level, a breakout of a support level, doesn't matter, but as long as they observe and they spot a breakout, simply because the breakouts, guys, they are giving a very significant information. Basically, they indicate the beginning of the next significant movement on the markets. So traders who adopt this technique are attempting to open a position at the beginning of a trend. Now, pullback trading, okay, is when the price of an asset, a stock, commodity, whatever, moves in the opposite direction of the overall trend, right? So in this case, if we have an overall trend that is upwards, okay, but we'll see some pullbacks, that indicates that pullbacks will last for a limited period of time, okay? It's not a reversal. It's just a short-term pullback. It's just a correction before another attempt to the original direction. Okay, so pullback traders, basically what they're doing, they are looking to enter a trade, but for a short time period. They open a trade just to benefit on this temporary decline, let's say, in the price if you are in an uptrend. But they could still hold their long-term position, which is based on the overall trend. And in this case, in this example, we have a rising trend. So in order for a trade to be successful, though, the market has to be moving in either the upwards or downwards direction. So uh, um, so guys, you need to understand that if you consider trading a pullback, okay, you need to understand that it's quite hard to make a profit from a small retreat if there is no underlying trend within which to trade. So one of the key criteria is for pullback traders is to actually make sure that there is an overall trend at the back. There are a lot of criteria that may be used to determine whether to enter or not a pullback trade. But there are two that they are the most significant ones. The first is to consider whether or not there is a support and resistance level available. Okay. And second, whether you are able to give yourself a position in which the market is demonstrating demand for, and supply when you have support or resistance accessible. So if, for example, you have a market that is moving higher in general, so it's in an uptrend. So any retracement that tests the support level, okay, before continuing higher, that's a desirable pullback trade. So basically, like here, a resistance and corrected. So pullback trade against the overall trend, short-lived, with support the previous resistance, and so on and so forth. So resistance becomes the level at which you might consider taking a pullback trade on the speculation that it will move against the trend for a small period of time. So for considering taking pullback trades, you need to have an overall trend, first of all. I mean, the market should trending, not sideways. You should have a clear upwards trend or downtrend. And to make sure that the asset, I mean, in order for you to open a pullback trade, it is optimal to have support and resistance converging in the same place. Okay, so yeah, so use trend lines, use horizontal levels, use slopes, Fibonacci levels, moving average to help you spotting a pullback and breakout as well. Why not? Yeah, so let's move on. This is another example, a combination of support levels, breakouts, and pullback. Okay, so here, this was a key support level since it was the asset repeatedly retested it, but failed to break it until we have that huge breakout over here below the support level. Sorry. So breakout, remember, is one of the most important concepts in technical analysis. So over here in this example, it was a sign that the market, the particular asset is entering a trending market, is changing into a trending market, and most precisely to the downside. And the fact that it continue moving lower confirm that we're gonna see a new downtrend developing. Um, so this is a common practice, basically. Especially the fact that it was a really strong support level for a while, make it an even greater breakout that what actually is. So a breakout trader in one of is someone, let's say, who enters a long position, sorry, a short position in this case, in this example, after the breakout, basically after the price break the support level, and as soon as um, um, as soon as as soon as this breakout attracts more and more sellers, you're gonna see that it will gain more and more action. The volatility is likely to grow, especially after the initial breakout, and price will typically trend in the same direction as the breakout. So a bit of a volatility initially, the support has turned into a nice resistance level. So we had a pull back to the previous support. Now it reacts like a resistance level and flip lower. So this is another entry point that you might consider. Basically, this one is better than this one, because over here you have the confirmation that now, from indeed, this support level now has turned into the resistance level, and uh, the long-term downtrend is officially here. Okay. Now. So guys, breakouts from essential support and resistance level are possible for any type of financial assets, including commodities, Forex, cryptos, stocks, indices. Okay? Same thinking, same mentality, same approach. You can trade a long, you can take a long entry when you have a breakout above your resistance, right? You're gonna, as you can see, it move and close above the resistance level. But it's not only that. For 3 consecutive days, we had seen higher highs. So that was a confirmation that it will continue. That we've seen that there is a development of a new uptrend. Okay, so an possible entry point could have been this one, the break of the previous high over here. Okay, another possible entry, it would have been on the rejection of this support area over here, because it's exactly where the resistance used to be, and now this resistance has turned into support. So this rebound, it was another entry point for a long position. Okay, you can confirm this by applying also your 50-day moving average, etc., etc., etc. Okay. Sorry. So let's move on. Okay, other types of positional trading. Basically, not other types, but things that you have to keep in mind if you're trading stocks, if you're trading indices, if you're trading commodities, if you're trading Forex. So stocks, if you're trading stocks, be aware that they are a bit more stable. They are more, a bit they are more they are preferable for long-term trends. Okay, and okay, the news don't really affect the long-term trend, but any market news that is regarding central bank's monetary policy or taxes or something that could these are the things are in news that can impact the stock prices. So so you need to have this in mind. Positional index trading. As you know, indices represent a group of companies, right? A group of companies, a group of industries, etc., etc. So also they present a consistent long-term trends. That's why it makes them attractive to position traders. Okay, because they're more stable option compared to the individual stocks, because an index represents a lot of stocks or a lot of companies or a lot of industries like S&P 500, Nasdaq, Dow Jones. Now, commodity, very similar with stocks, generally aligned with long-term trends, but is more volatile than stocks and indices. We can see commodities stabilizing. So it's more volatile than indices and stocks, but it's more stable than cryptos and currency pairs. Okay. And last but not least, the Forex currency pairs. You are well aware that is one of the, basically they are the ones that they are really, really high in volatility perspective, less favorable by position traders, exactly because they are very, very volatile. So Forex trading is not so popular for position traders. It's more popular for short-term traders, day traders, scalpers, etc., etc. Okay, so it's not. I think you're not gonna find someone that is a position trader and trades currency pairs. Okay. Now, something that I forgot to mention in the beginning of the webinar is that, as usual, basically, either if you are a scalper or a swing trader or a general, any type of trader you are, you need a plan. So a position trader needs to have in place a good plan, maintaining its journal. That will be key for for monitoring and maintaining a position trade. Everyone should have a plan. Everyone should have a plan. As we have repeatedly say, doing your homework, writing everything down, predetermining your entry level, your stop loss level, your target level, controls the risk. Okay? And controls your emotions as well. So please have this in mind. Sorry, don't know why. Oops, I mistakenly, sorry, wrong. Mistakenly forgot some slides over here that shouldn't. I should have belong to different different. Okay, here we are. Okay, we can move on. Okay, and we're reaching the end of our webinar. Martin, when we say 50-day moving average, we are referring to the daily chart, daily. So some things that you need to have in mind for position trading. Some limits, risk, advantages, disadvantages. First, let's start with advantages. Obviously, it's a long-term strategy, okay? But if it's done properly, it can lead to big gains. However, uh, um, um, also, as I mentioned earlier, it's quite easy to execute it. Okay, but it needs a lot of studying. You need to go through the data, the financial reports of if you're trading a stock, the financial reports, the earning reports. If you're going through, if you're gonna open a position trading on commodity, you need to study what's the prospect in the near future, what action the central banks are going to take in the near and long-term future. So what's the GDP growth is saying, what's the inflation in that country, so whether the country is in a slowdown or in a recession or in a growth, etc., etc. So it is a long-term strategy that could lead to big gains. It is easy to execute it, but once you have done a proper research. For all these reasons, it's less stressful because it's long-term. You don't need to be monitored on a daily basis. So you have more time to spend other transactions, on other approaches, let's say, more shortly ones, etc. However, even though the position trading, because a long term, it considered to be the risk is considered to be lower than a daily trading or swing trading or scalping. Have in mind, guys, that if a mistake is made, it will likely be fatal. Okay, so if your trader goes against the trend, then they might end up losing not only the initial deposit, but actually but also the time they invested into it. Now, disadvantages or limitations, so some risk. Okay. Liquidity issues. Okay. Liquidity issues might occur. So because basically a position trading is a long-term trade, right? So that means that your capital will be locked up for a long time period. Also, you need to keep monitor also the minor fluctuations, because if you completely ignore them, they can become a full trend reversal and you will not realize it on time. Okay, so minor fluctuations, they shouldn't be ignored, they should be monitored in order to avoid any to end up basically into trend reversal, because that will mean significant losses for you, especially if it's a very strong price fluctuation. Then you might consider closing your initial position before that leads you to a total loss of the investment capital. Also, if the position stays open for a long period, you need to be aware of the swap fees. Okay, the swap fees can accumulate to a huge amount, so keep an eye on the swap fees as well. What else? And that's pretty much it. As I mentioned earlier, be aware. You need to the risk that the position trading, some of the risk that the position trading, basically some disadvantages of position trading is the swaps, is the liquidity issues, is the fact that you need to keep an eye on the minor fluctuations in order to avoid in order to avoid being surprised, basically, if that minor fluctuation ends up being a trend reversal. Yeah, so that's pretty much it. So yeah, so guys, basically we have reached the end of the webinar. Went through position trading with breakouts, with pullbacks, the key 50-day moving average and how you can use it. Also, we went through so some breakout, pullback, sorry. Okay, 50-day retracement trading strategies as well. Support and resistance levels. Yeah, we have covered everything. So now it's time to let me know if you have any questions. We have seen some examples as well, so let me know if there is anything that you feel that maybe you didn't comprehend and you need me to go through it again. Anything you need, just stick in the question box before we end this session. You're welcome, Barak. No, nothing. Okay, guys, if there is, I can see that everyone is okay with the session. So I'm gonna call it a date. Okay. So, wait. Okay, Alfred. Yeah, I'm waiting. Don't worry. Let me know. I'm waiting for your question. Yes. Oh, And what is the if? Please can. Okay, guys. First of all, don't worry about the recording. You're gonna receive it in your inbox within the week, let's say. About should be, but basically within the day, unless if we have any technical issues. But you're gonna receive your the recording for today's webinar in your email. So look for spam. Maybe sometimes it goes to the spam folder. Okay. So, and what is that? Okay, if you're Alfred, if you're referring to day time frame, okay, RSI most of the time for most of the assets, the default setting for the RSI is it works quite well, but you need to make sure that I don't know for which asset you are referring to. Usually the default setting is just fine, but you need to always check, double check basically. Apply the default one and check whether, go backwards, okay? Go backwards and check whether it provided accurate signals or not. If it hasn't, then test either deducting it to 7 period or increasing it to 28 period, 20th period, and so on and so forth. So it depends from the asset. You need to always test different settings until you find the one that it provided the most accurate signals. Okay, so that's that. Okay, your question, very good question. It is advisable for beginners to do position trading. Okay, okay. So, actually, it's a very good question. Okay, as we mentioned already, is for anyone that is a long-term, has a long-term perspective. Okay, on the asset. First of all, you need to check whether it's something that it suits your personality, first of all. But considering the fact that it's a bit less stressful, so there is some emotional control over there. It's easy to be executed. Yes, it could be. We could say that is a nice quite it's a good strategy for someone to start, but any beginner, okay, first of all needs to familiarize himself with the market, dynamics, with the market risk, okay, before trying any kind of strategies, guys. Okay, it's not just straightforward as that. I'm a beginner. I'm gonna start with position trading. You need to make sure that you understand basically the basics. You need to get familiar with the market dynamics, the potential risks, okay? You need to understand the fundamentals, because position trading relies on fundamentals mainly, and the technicals are used afterwards for confirmation, right? So you are a beginner, but do you understand what let's say a rise in GDP means for the US economy, for example, or what an easy monetary policy means for a US economy, or for, let's say, so you need to make sure that you understand the fundamentals, okay? So it's not as straightforward as being a beginner, so I'm gonna start with position trading. Okay. Okay, guys, I'm gonna call the date. As we said, you're gonna receive the recording soon. Thank you very much. Have a great day ahead and take care. Thank you.